better. സാധാരണ yeah, ക്ലൗഡിലാണ് നമ്മൾ ചെയ്യാറ് സാധാരണ.
Okay.
We'll
Right,
give it
let me know
one
when
more
we
minute
can
and we can,
start.
yeah, one more minute and we can start. I think we have 25 participants. I think we'll just give one more minute and then start. Thank you all for the patience. Yeah, we'll just give one more minute just to check whether more people will be joining. So. I think we can get started. I'll stop sharing. Smita, you can take it from here.
Sure. Abhish, you're going to be sharing your screen, correct?
Yep.
Can you try and see if you are able to do that? Yeah, perfect.
Okay.
All right. Well, thank you everybody for joining today's webinar. My name is Smita. I'm the Mentorship Director for 2025 MEA organization. Today we have Abhish. Abhish Abraham. Abhish is a leader at with Deloitte for the merger and acquisition organization. And today Abhish is going to help us gain some insights into how merger and acquisitions impact strategic business decisions and how they can possibly also impact your career transformations. Especially us as engineers, we don't get too much insights or we don't understand too much about merger and acquisitions. It all goes on mostly in the business area. So Abhish, we definitely appreciate you taking the time to educate us about this today.
I'm happy to do that.
So with that, I'll hand it over to you, and you should have control to take your presentation from here.
Yeah, thank you.
Abhish, I don't know whether it's on my side. I could see that. Yeah.
So we see your email right now.
Email now, yeah.
Got it. Okay. Is this okay?
Yeah, now we see your PDF.
And there is a blue box on the right side which shows as reopen close PDF. I don't know whether it's just for me.
I see it as well.
Yeah.
Yeah.
I was trying to put it on PowerPoint, but it was blocked. So hopefully this works on.
Yeah, we can see
on PDF. Okay. Well, thank you for the opportunity. I have had a chance to meet some of you, maybe most recently at the GBM meeting. But for those that I haven't had a chance to meet, Abhish Abraham. As background, my engineering was in Bangalore, which is where I was. I grew up in Bangalore, and then came to the US, did my master's at LSU in Louisiana, and then since then I've always been in consulting, management consulting more broadly. I started with more in growth strategy, and then when you talk about strategy, that's usually people are looking to grow or people are looking to cut, and then I specialized in mergers and acquisitions along the way because it is one of the fastest way to for companies to grow, right? And my background is beyond that. I've done about on average 8 to 10 deals a year for the last 10, 15 years. So most of what I will share today will be from those learnings and experiences. And advised clients, Fortune 10 onwards to mid cap companies along the way in terms of how they should think about M&A. And within this, most of my industry experience has been in just being in Houston, has been in energy. It was something that just happened naturally, but also back when I started, consulting had a lot of travel, and I was thinking that if I picked up energy, I could find more local clients and then reduce my travel. So that was the reason I decided to do energy. But along the way, I think it made a lot of sense, and I enjoy the the background here with the energy companies, but also some other large tech companies also that I've been involved in. So with that as background, what I wanted to cover off today is just start with, okay, what is M&A? Mergers, there's acquisitions, what's the difference? Very nuanced. Why do companies decide to go through an M&A? And if they go through, what is the process? And that becomes important for each of you, because you will be either, be part of a company that's going through an M&A, and maybe you may not see what's happening in the background, but it's important to know. That way, you know where you could interject and maybe, provide some inputs. Or sometimes uh, there are cases where you may be on the wrong side of the deal, and that's pretty common as well. I had some folks that when you're going through an acquisition, there's also some cuts and people reorganizations, and it's a very stressful time for people, right? And sometimes if you're in certain parts of the organizations, you're somewhat insulated, and that's a good thing. But in some cases, you're not. And then finally, I want to maybe just know that this is a very technical crowd. I just want to talk about how do the numbers work in an M&A, right? How do you price that you're going to pay this much? And if you're paying X amount, it's important that you show how you're going to get that money back over a period of time, right? So those are some of the high level points I think would be helpful for this group. With that, any questions? Is there anything else that you were wanting to maybe think about M&A that you wanted to understand? I'm happy to maybe pivot as well. So I'll just pause there to see if there's something else that the people on the call wanted to get out of today's meeting.
I think maybe Abhish, once you go through this, probably there could be questions, because a lot of us don't know other than what we read in the headlines of the newspaper, other than that, we don't know much about it. So probably once you go through it, there could be more questions.
Okay, got it. So maybe it's important to just understand what definitions are, and then we'll get to it, right? So it's used very interchangeably, one versus the other on what's a merger, what's an acquisition, right? It's important to think about mergers as when companies are coming together and you tend to see a new company being formed, right? One example was Fiat Chrysler a couple of years ago, formed with Peugeot from Europe, and you have the new company here that's based in the US called Stellantis, which now has a lot of the brands that you see in the market, right? So that's an example of a merger where two companies have come in and you have a new company that's created, right? So it does not necessarily mean that you change the name all the time, but if Dr. Pepper bought Keurig, they still tend to keep their names, but still a merger. Acquisitions are things that you see more often, where there's a very large company that may take on another company, and you just rolled into the parent company, right? Whether it's ExxonMobil, Pioneer, for those in oil and gas, that happened a couple of years ago, or Amazon and Whole Foods. You don't see it very differently, but that was a very large acquisition. Instagram or Facebook buying Instagram, those are all acquisitions. So it's important to just know what the two differences are. And with that, there's some nuances that I'll just bring out of there. And there's some interesting things here when you think about M&A in terms of, okay, why do companies do this, right? Before I go there, any thoughts on why would companies consider an M&A? Just trying to see, how you all may be thinking about if a company is trying to do an acquisition or a merger, what would be the reasons behind it?
Probably reduce competition.
Yep, that's a very important one.
Between the market cap.
Yes.
So some company already has a niche, and they can just acquire that company if they want to get people of that skill set,
Yep.
or get into that market, like
Yes.
what Facebook did with Instagram.
Yep. Those are all great points, right? Sometimes it's also it may be a value chain play, right? So you're in a certain part of the value chain. If you take say the energy industry. If you're an upstream, how do you get into midstream, or do you get into exploration production? There's ways to even control the value chain. So there's all great answers. So those are all the ways that companies think about this one. So a few of the points that you mentioned are here. The first and foremost is they're looking to grow, right? And a traditional way that companies will grow, there's only two ways to do it. Either you sell more of your products, or you find more customers, right? That's the only two simple ways to traditionally grow. What's called as a organic way to grow, right? This is seen and is termed as an inorganic play, where you can get into increase your market share, get into new geographies. And then the other part of it is synergies. And I'll get into this because every company, especially public companies, when you're making a deal, you announce to the street, right, for your investors and to the quarterly announcements that what synergies are you going to get out of this deal, which is a fancy term for savings, right? And there's sometimes savings and there's sometimes revenue growth. So this is a very important piece to just get your head around of understanding why these deals happen. Sometimes you get, cost savings. Very simple way to think about it is when two companies come, you don't need two finance departments, you don't need two IT departments, you don't need two HR departments. So that gets compressed a little bit. But also you can get cross-selling. You can, if you have higher competition, you can increase your pricing power in the market. And then another one is just diversifying across the value chain, as I think people mentioned on this. And then you also get new technologies and capabilities, right? And you see this becoming more and more relevant, where you have very large companies that may buy even startups, right? Or even invest into companies that are not IPO yet, but they can see how some new technologies are getting formed and become part of that ecosystem, so that there's learnings within that startup environment that you can bring on. And for the startups, it becomes very important that if you have a very famous company that's ready to invest in you, the startup gets access to markets, right, or the customers or the products. So these are all some of the reasons that that companies pursue M&A. Any questions on this?
I had a question, Abhish, on the merger side. Acquisition, typically the company that acquire, maybe one of them could be financially more strong. But in terms of merger, if we had two companies, if both are losing market share and all, so do they typically try to do this? Like, does merger helps them so that it becomes a stronger entity after the synergies and all? Probably they can compete in the market well, or does it have to be always one partner has to be strong to do that?
No, it does not have to be. You may see that, and that's what's called as merger of equals, right? It's less common that you see that, and even from the Department of Justice and the government, they usually prevent those type of deals from happening. Like one example could be Sprint and T-Mobile, right? There was a lot of pushback because you reduce competition in the marketplace, but you see less and less of mergers of equals. Things that it's very hard to pull off. Like I think it was the JetBlue deal that fell through, or even a couple of months ago, HP was buying Juniper Networks. That was again seen very closely as two very large companies coming together. But you take off the competition from the market, and the government doesn't allow those. But it's rare. It's becoming more and more less that you see those kind of very large, merger of equals happening. Airline industry is another one, right? It's like you can almost assume that some of the large airlines companies, their consolidation will very unlikely happen. The last one was, I think, United and Continental, or maybe United, and so but you see that very less. It's going to be bigger ones buying smaller ones, or a value chain play, or another way to do it.
Okay, thank you.
Abhish, I have a question here. So you mentioned that the government doesn't allow those. What role does the government play in acquisition and mergers?
For public companies, they play a much stronger role. Any deal needs to get through the SEC. There's the HSR regulations, and the Department of Justice, right? So each administration tends to view it a little differently. For example, the Biden administration blocked the highest number of deals ever, right? Last year, they have a way to make sure that the markets are competitive, that there's not too much consolidation happening, and the government views it in the lens of what's the impact to the customers and the consumers, to make sure that there is enough level playing field and you're not getting too much consolidations in there on that. So they do have a pretty strong role to play in these deals.
Is there only a certain tier of companies that the government gets involved in?
It has to be the government gets involved in if it's a public company, everyone goes through the regulations, right? Irrespective of whether you're listed, irrespective of the size. But where there gets more scrutiny is when it becomes of a large scale, to where they can really, not be in favor of it. But there's also other stage gates, right? The shareholder voting that needs to happen across the companies, and I'll just walk through that life cycle in a second. But they do play a key role going into the life cycle of this deal.
Thank you.
Okay. So maybe from here, we can just walk through how does this all play out, right? Suddenly you see, like the example I said, Walmart or Amazon buying Whole Foods. Where did this all start, and how did this play to where it made it to the news? You could just maybe think about it as it all happens in different stages. And at the core one, many companies and the corp dev teams, along working with the business unit leaders, will have an M&A strategy defined, hopefully over the next, it's with a 5-10 year outlook, in terms of which markets do we need to get into, which geographies do we need to get into, what products are we not seeing, where are the competitions making deals that we may also have to start making deals, right? So if you see, there was a lot of activity in energy in the upstream in the last 2 or 3 years with Conoco, Concho, Pioneer, Exxon, or Hess, Chevron. There's a lot of activity. So there's a first stage in terms of just understanding how do you want to think about M&A over the first few years. From there, there's the items around, okay, who's going to be the target, right? And there's a certain set of criteria that you may need to funnel through, that you may have 20 candidates and you're pushing them through a certain criteria. They need to have a certain number of revenue. They need to have a certain number of margins, right? Profits. They need to have a certain number of competitive advantage relative to the others. So you could go through a target screening effort and come to say that, okay, here's 4 or 5 candidates that may be able to join this the deal. Then what happens is there's a initial deal negotiation, right? Which is what the intent is. Think of it as if you're buying a house, you're getting it under contract, right? That's the easiest way to think about it. And from contract to when you sign, you have about 2 months to close on the house, right? So that's the way to start, relating this, so that it's fairly easy. Most of the people would have gone through buying a house. You selected your houses, and now you're going through getting it into contract, which is called as a letter of intent. This is the price I will pay. I will close in N number of days, and as part of it, these are some negotiation items that I will go forth, right? The next part is due diligence, right? So think of that, if I use the same example, that your house is now under contract and you have a close, the first thing you're going to do is do a home inspection, right? What is the condition of the house? What was that last time things were remodeled? Based on that, you may need to put X amount of dollars to fix the house before you want to keep it, right? So this due diligence piece is where things can get a little more complicated, right? Because on both, you have a buyer, you have a seller, you have investment bankers on both sides negotiating for each other, and then you have advisors or consultants like Deloitte and others that are figuring out and testing the deal hypothesis, right? Are the margins correct, right? Has there been a sudden drop off in margins? Why did that happen? Are most of your revenue coming from a handful of customers, right? Or are there big contracts, revenue contracts that's expiring 3 months after the deal is closing, right? Or are there significant, litigations that the company is in, which you're going to take on the liability if you buy that. So this is where you're going to come up with an updated deal construct to say that, look, we found X, Y, and Z that we think is going to be a risk to this deal, and as a result of that, we want to reduce or adjust the pricing on what we want to pay for the deal. Very similar to how you would negotiate on a house that's under contract, right? Very similar logic here. And then you get into deal closure, which is getting all the legal, the regulatory requirements, all of that passed, and then finally you get into integration, right? And that can take 12 months, 24 months, 36 months. It's a very long drawn out process. So this is the way to think about it. And if it's a public company, the deal number 5 that you see here is when things are announced, right? So till then, it's all done with code names on the project so that people cannot trade those stocks. And there's just a lot more confidentiality and sensitivity when you're going through 2 through 4 on it. So if you're on the deal team, there's a lot of restrictions on what you can do during that time, confidentiality. You can't talk to the other's customers, IP, R&D, all of those gets under very lockdown environment. But that's the overall process. You all may have experienced some part of it, maybe along the way. Maybe it's the deal closure and how companies are getting integrated. But anything jumps out of this? Any questions?
Abhish, all these are, does it happen like with public information, or these things happen like, since you mentioned about the share, or does it happen like without general public knowing, and it's only revealed at a certain stage, or is it
Yeah.
generally available?
Yeah, it is revealed only at stage 5, right? When the deal is announced to the market. So all of this happens beforehand, right? So if you were to just take a simple example of, say Microsoft's going to buy Google, which I don't think will ever will play out, but uh, during this phase, Microsoft, if they're buying Google, they would want to know their entire, which are their largest customers and what are the rates that they have. And these are all sensitive information that no companies want to give away, right? So which is why they create what's called as clean teams, which are, people selected from both organizations put in a very restricted environment to test and validate some of those initial hypotheses on deals, so that every assumption that you made as to why you want to buy this company is holds true till it's announced. So it is in a very, very confidential environment during this time.
Okay, thanks. Just one more follow-up question. Like sometimes you hear in news that a company tried to take over and the other company shareholders resisted, pushed back. Is that considered as an M&A, or is it like a takeover kind of thing? Is different?
Yeah, it is. It's a hostile M&A, right? And the way that plays out is you have what's in the market called as activist investors, and they, they will look at how the company is performing and try to, over a period of time, buy more shares, right? And that way they get to a certain point to where they can influence a lot more, right? I think the most recent one is Honeywell, which is going through some level of activist investment, where they are looking to split the company into much different, smaller portions. It's unclear whether this will happen or not, but when that happens, it's a split of the company, because they feel like the individual portions of the company may do better than the whole, right? And there could be certain parts of the business units that's dragging the entire organization down. So they're pushing for a sale of that part of the business as well. So it is common that you see some level of activist investors, in these deals.
Hey, Abhish, Ramashankar here. Nice session still now. Currently I'm working in a product company called IBS. So we have gone through like 2 acquisitions, acquired 2 companies, product companies for the growth. One of the major challenge in practicality I've seen is like after acquisition, integrating to the organization is challenging. We have seen in both this major acquisition this happened. And as you rightly said, when you look into the no risk in terms of the long-term existing revenue, the challenges in the contract, the litigation, and all. But more than that, again, organizational culture also is a major no challenge we have seen in terms of like no integrating into one business unit and then trying for the growth. And including placing the sale. So, from a merger and acquisition perspective, how much you plan or give like insights to the acquiring company, how much the integration can be seamless and smooth? Because end of the day, after investing, it takes like almost like every organization is taking like 1 to 2 years to get it smooth and running. So, what level of insights during the merger and acquisition you give for the integration and change management?
Yeah, fantastic question. Um, the short answer is, you know, as advisors, we're heavily involved, right? So on stage 6 onwards. In fact, I would say majority of where advisors spend their time and where the revenue comes from is all 6 and beyond, right? These, what you see from 2 through 5 happens very, very fast. 3 to 5 weeks sometimes, right? Sometimes it's 2 weeks because there's multiple bidders you need to get through, very fast time. So one 2 through 5 is a very, very high pace, high pressure, multiple bids environment, right? So during that time, you have to start thinking about what are the integration considerations, right? For example, you may think that the back office functions, whether that's the SG&A functions, are all very similar. You may want to consolidate that going forward, but when you get into integration, it might be a little different. So let me unpack your question into a few answers, right? On the culture side, during diligence, there is usually a top-to-top discussion around what they call as key resources, right? Who are the absolute necessary people that we have to make sure are retained in the target company for maybe 12 months, 18 months, because there's a flight risk of them leaving the company, if these things happen. So the people part of it, we try to just plan for it early, and the way to do that is maybe there's a very good payout for people that stick around for 12 months, 18 months on that. Then in terms of when you're looking at the around contracts and other items, you may see that there's a lot of contracts that if the acquiring company takes on, their rates may go up, or they may trigger a breakage of terms. So there's a one-time payment that needs to happen, right? There could also be differences in how you go to market. For example, one company may go direct to the customers, another company may go direct to the distributors, so that when you go as a combined company, all the distributors may now think that, look, I don't have a play in this game anymore. So they may start to play, move out. So you want to start thinking about how do you incentivize the distributors to stay in. So during diligence, we think about what are the critical items that will be difficult to bring the integration around people, around the contracts, around the sometimes the systems part of it. And that's why integration takes, like I said, 12, 18 months to truly function as one company going forward.
Thank you, Abhish. That's a nice answer. But I one suggestion from my side is like, when I was telling, say I'm responsible for executing that integration, okay? But we will never get involved during the merger and acquisition phase or those discussions, because no, always I used to think like, if I was involved in, I would have easily highlighted these points, which is quite normal, like no. So have you seen whether the integration or operational team heads coming and getting involved in any point, or they get interviewed, or feedback's been taken? Because most of the time the acquisitions in our company, I've seen that is not happening. When it comes to the reality, that's where like we all feel the heat. So do you think like currently you take the inputs from the head of integrating the operations, or always this happens in a totally different level where I was always in like the business finance and the strategic team involved in, and then like the reality is totally different when it comes to the execution, including looking into the contracts. Because I sometimes used to see like, no, it would have been an easy ask where like, you could have find this risk in these contracts. Because normally we used to execute the contract and see like these are the account management issues. You know that the client is going to lose in like next 6 months. None of these things, I don't think like, it gets highlighted in an earlier stage. So, I mean, just a suggestion. I don't know how far the people who are doing the real execution heading that get involved in the initial stage of this discussion, as you right, like said, maybe sixth round of the merger and acquisition process.
And this is something that's very common, right? There's a few reasons why that happens. Um, if I use the example of, okay, you have a house under contract and you need to close on it, what are the top things that you would look for? Foundation, roof, AC, maybe if the kitchen is updated, right? All of those things, right? And then when you come into the house, because that's all the time you have, right? You just have 1 month to go fix all of these issues. But when you come into the house is when you see there's a lot of other things that could have been fixed. So there's simply the process limitation and the timing limitation that you simply cannot understand all the concerns that will be there after you buy the deal, right? That's one reason. The second reason is just confidentiality, because it's unclear whether the deal will move forward or not. So in many cases, even on some of the current deals I'm working on, the like the CIO itself is not involved in anything because it's just not there yet, right? So the level of people that get involved is usually C minus one, C level minus one at that level of negotiations, because you're still bidding. You still don't know if that buyer will buy. At that point, given the confidentiality of the deal, you don't want to bring a lot of people in. So that's the confidentiality is another reason why you cannot understand all of these items before they go out, right? So I would say that on every 4 or 5 deals I work on, only one passes, right? Only one gets to announce. So it's a big funnel that companies are going through. So it's unclear whether you'll get through. It's very similar to, you may put multiple bids on multiple houses, you may get only one, right? So hopefully that gives you a flavor for why you see some of the pains in integration that could have been addressed during diligence.
Thank you, Abhish. Thank you.
Hi, Abhish. This is Deepthi.
Yeah.
Thanks for the great sessions. I have a question related to this, especially on the target screening and deal negotiation stages. I think they are the critical and core initial stages, right? So are you guys using any particular strategy for this in the organization level, or is there any specialized the vendors help will be taken during that stage? Just want to understand like what are the common vendors or the service providers in that area specialized for this.
Yeah, yes, we do. I think the way to think about it is, maybe I'll take the first one on target screening, right? Um, there's a methodology sometimes many companies can relate to, as in, okay, which markets do you want to enter, and in those markets, which part of the value chain do you want to play in, right? So that creates a box, right? So if I take, let's say, energy as a whole, right from exploration down to refining, there's multiple ways you can be in that. So when you're looking for a target, the first question you want to ask for is, where do you want to play, right? It's where to play is the term that's used largely. And in within that you would then figure out, okay, what are your top criterias on that, right? How mature should the organization be? What's the revenue? What's the margins? What's the customer mix? So all of that will help you define that, okay, if and I don't think this will ever happen, let's say I'm a Halliburton that wants to get into refining, um, which refiners will I start to look at? And there's a handful of refiners here, right? And that's how you would put certain criteria on their location, their revenue, as to figure out, okay, maybe I want to get into refining on that, right? Or it could be another example could be a car maker trying to source batteries, which is very common these days. And so where do you source those batteries, right? that could be another way to think about it and figure out what's your criteria to do that. When it comes to deal negotiation, it is a lot of the lawyers that get involved in it, in terms of your closing conditions, your payouts to the executives, the share price in which you're buying it. So that part, think of it as less about advisors like Deloitte, but a little more around the M&A lawyers, right? So that's where you see some of that. Hopefully that answers your question.
Okay, thanks. So, like a Deloitte, is there any other kind of the vendors help will be needed, kind of specialized companies in those areas? That's what I was
Yeah,
actually looking.
yeah. M&A consulting is a fairly mature,
Okay.
business. Um, Deloitte, Bain, BCG, Ernst & Young, McKinsey,
Oh, okay.
all of them get involved in 1 through 4, 5. But the integration part is where you tend to see a different set of companies come in, because then you got to bring in 2 IT systems together. You may need to bring 2 HR systems together. So you tend to see more of the the tech-focused consulting companies being more involved in 6 onwards, right? So it's different players here, but most companies it's a very competitive space. We compete with a lot of companies when we're in this process as well to win the work.
Okay, thanks.
Yeah. Okay. So maybe I'll talk about, this is the last topic. There's a couple of slides. I talk about synergies, right? This is very, very core to making the deal, right? And synergies is just a fancy word to say that when 2 companies come, the sum of the parts is bigger than it individually, right? So 1 + 1 is always greater than 2. So why is this important? When Amazon bought Whole Foods, they paid 27% higher than what the value of Whole Foods was, right? That's the price they paid to buy that. So you're paying above and beyond what a company is worth, right? When Exxon bought Pioneer, it was 60 billion, right? And they said they're trying to get 3 billion in cost synergies on an annualized basis. So this is an important piece of it, and I'll get into why. And there's 2 types of synergies, which is the first one is cost synergies, very easy to think about. It's 2 buckets. One is labor. Unfortunately, it's headcounts that are replaced in the companies when 2 companies come together. It could be the systems, the hardware, infrastructure, applications, all of that are big buckets of savings. And then there's revenue synergies, right? So you can go to market together, right? As you can see, how Amazon can benefit from having Whole Foods, because there's a lot of revenue synergies, right? That you could, buy there, sell here, or buy here, drop off there. You go drop off a packet, you may end up buying things from Whole Foods. So there's a lot of revenue synergies that come from this. So this is an important piece of the deal, and I'll get to this in a second here as to why it's important. And I've just brought this, somewhat of a. I don't want to make it too quantitative, but it's heavy, in math and in some of the quantitative analysis that goes forward, right? So just bear with me as I walk through this. On the left of this, you just see what the value of a company is today, right? There's an acquirer and there's a target. And when you're buying a company, you have to pay a premium. Usually you pay a premium for it. And that premium, think of it as a multiple of the margins that they may be making, right? So technically they call it as EBITDA, which is earnings before interest and depreciation. So let's say I'll just do some simple math here, where there's $1 billion revenue company, their margins, right, after operating expense and everything else, let's say they make 100 million in profit as their margins. Against that 100 million, when you look at it, there's a certain premium you want to pay. You may pay 2x, you may pay 3x, you may pay 4x, which is the multiples that is needed. So in this example, let's say that you pay multiples of 2 or 3x, then you have to start justifying why you paid that much, right? And that is why you then get into figuring out, okay, how am I going to get back the money that I paid extra on this? And that'll come in terms of revenue synergies, what I said, the cross-selling across the companies. There may be new products. And then there could be another one around cost synergies, where all the savings come up, right? Whether the vendors are consolidated or labor or headcount is reduced, to ultimately there's a bigger value for the company, right? So, very simplistically, you should make sure that the value that the acquiring company has is going to be above and beyond the premium that's paid, right? And how do you do that? It is through a combination of revenue and cost synergies, right? And this is where the integration piece is not just about bringing the two companies together, but you got to start punching above and making sure that you're getting everything that you made. Because most public companies, when you make a deal and it's announced to the street, you have to almost always tell what your synergies are going to be that you plan to achieve, like the example that I gave with Pioneer and ExxonMobil. So becomes very important to understand the deal logic, the diligence. How should I think about the value of the company? How much am I paying over and above what the value of the company is? And then ultimately, when the acquiring company goes to the shareholders on a quarterly announcements or quarterly earnings, you have to be very clear why you paid extra for this, because you also see where companies make an announcement and suddenly the stock goes down, right? It's the complete opposite, and there's many reasons for that. But this, I thought, is something that maybe people may not necessarily see as to why companies are doing deals and the importance of it. So I'll pause there. There was a couple of slides I went through fairly quickly. See what questions you may have.
Just a question on the share price, Bish. So on an acquisition, the company that's acquiring, like in this case, ExxonMobil was acquiring Pioneer, so they are spending money, right? So is it generally a trend that share price of ExxonMobil, in this case, whoever is acquiring, take a dip first because they are spending money on acquiring, and the other one, because it's being bought by a bigger player, it goes up like that? Or
I think it's a fair assumption. Sometimes both go up, but usually the acquirer, everyone's excited about it, right? And that, oh, we're getting bought out by a different company, and it does. You tend to see that, which again goes back to why it's extremely confidential, so that there's no insider trading of stocks. All of those items on this, there's a good chance that the target's stocks go up. And sometimes even the buyers may go up. Otherwise, it may or may not. So it's a fair assumption that you may see that played out that way.
and since both companies would have been publicly listed, and that step number 5, when it was publicly announced, after that, at some point it will become one share, right?
Yeah.
But
After close, yeah.
After close, okay.
So it's announced, and then there may be another 1 or 2 months to where it's we're going to close the deal, right? By close the deal, that's the step between integration and this, that all the people have to be rebadged, brought into the new company. Payroll has to be executed from the buyer, right? So you just need time for those things to happen, and that's why there's some delay in terms of announce and close. So those are two discrete steps in when the deal is announced and when the deal is closed.
Okay, thank you.
Okay. These were the last slides. So anything on this topic or anything else comes to mind?
Abhish, just one more question to the Rama here.
Yeah.
So if you have got like a trade-off between a bigger top line versus profitability, I know one size won't fit for all, but if you want to do like a trade-off between the bigger top line versus a profitability, which one normally you choose between picking these things?
Yeah, a great question. See, mature companies, especially public companies, they all care only about the bottom line, right? Because that's where the earnings are driven off your margins, and that's where the earnings per share gets given, and that's how the dividends are paid out in each quarter. So almost always on mature public companies, it's always at the margins, except right in a high growth environment, right, where they could be there could be not made margins yet, but it's in a high growth environment. And in those cases, especially for tech startups or new emerging technologies, then you can say that, look, I'm not doing this deal to increase my bottom line. I'm trying to do this deal to make sure I get new capabilities. And I recognize that it may be a losing margin business, but for me, that capability is important. And then I would value the deal based on the top line. So most of the tech startups that are in pre-IPO or close to IPO, you get value the deal on a annual recurring revenue basis, ARR. But for the more mature businesses, you start looking at it at a margin level.
Thank you, Abhish. Thank you.
Okay. Manoj, I don't know how much time we had, but hopefully, we're within time. And if there's, we'll just keep it open if there's any other questions.
I had a question. This is Madhav.
Yeah.
Yeah, so you said like a lot of established companies, pretty much only care about their bottom line. But do you think so companies like Stellantis, like you gave an example, like they cut a lot of cost on their production for like vehicles, cutting their quality, to give back more to their shareholders. But right, currently it's not working out for them. Sales are like extremely down for them. So do you think companies will change how they, you know, um, change how they do the cost cutting? Because, certain companies, they cut a lot of costs, but it doesn't work out for them in terms of like product and customer feedback. So you think it'll change, or you think it'll still be the same way?
Yeah,
Just had
I
a
think
question about
that's a great question. I would say that M&A is a portion of the overall story, right? So it could be that that the companies that you just mentioned, which is very common, right? They're not doing that great, but to just be sustainable and being competitive, they need to do an M&A, right? But that does not mean that they can lose focus on running the business, right? And to run the business, irrespective of how much extra you paid, you still need to, every quarter come out with your earnings. There is still pressure, right? So M&A is a portion of the story. It helps you get through stagnation and put a more positive, outlook to the company. But very soon, after the first couple of quarters, the analysts and the investors on the calls, they care less about the stuff that happened. Now show me where your synergies are. Show me where you're taking the costs out, right? Show me why the earnings per share has to increase. So that is why they start getting more pressure. And unfortunately, they go back to the old ways of trying to just keep costs, and then they forget why they did the deal, why they paid the premium. So, I mean, we have metrics that, 30, 40% of deals don't even realize the premiums that they paid for the reasons that you just mentioned. So it's not all green and very easy to do. There is a lot of pressure, irrespective of the deal happening or not. Hopefully that answers your question.
Yeah, it does. So pretty much they can't just stop at cost cutting and after the mergers and acquisitions, but they have to figure out what the other company needs and what the customer requires and stuff. Okay.
Absolutely.
Thank you.
Anything else? Manoj, I'll leave it to you to tell, how much time we have. And
I think we have 8 more minutes. Let's check any more questions. Anyone, please feel free to.
Abhish, I have a question. So when you are, let's say you develop your strategy for the year, or you have your 3 to 5 year strategy. When you are developing your leads that possibly may or may not work out into deals, do you need to keep the other company informed about it? Like, let's say there's a larger company that's strategizing on how to acquire a few smaller or fairly less larger than the company that is strategizing for acquisition. Do they need to keep the other company informed about all the information that they're collecting on them as you're forming your leads?
Are you talking about the targets as the leads?
Just, yes.
Yeah. No. See, the way this works out is this is where the investment bankers come in, right? And they're the ones that may have to say that, okay, think of investment bankers as if I were to use the real estate thing as brokers, right? They know which companies are up for sale, right? They know which ones are desperate to be bought out. They know which ones you may have to pay a premium. So this is where there's a little bit of uh, back and forth in terms of the corp dev may say that look, we're interested to make a deal, bring us some targets, right? And only when it gets to the internal reviews to say that, okay, we would like to put in a letter of intent, only then do you need to keep them informed. And after that, they may also have other buyers looking at that company. And depending on the terms, you may want to keep them informed, or you may just go pencils down. It's very common. It's just like buying a house where you may be interested and find something and then decide not to move forward on it. And that same where you put a bit offer on the house, there's other people that put an offer on the house, and they may be negotiating with them as well. So it's a very, very dynamic environment between advisors, between the buyer, between the target and the investment bankers. There's a lot of moving parts to it. There's no reason to keep everyone informed.
Yeah, Abhish, just one more question.
Yeah.
From a Deloitte perspective, have you ever worked on any value-based commercial in any major acquisition, merger and acquisition, where you projected that this is the target growth and revenue, profitability, top line, bottom line, based on which you'll have a value-based commission or commercial that can be set up. Have ever Deloitte worked on any value-based commercial model pertaining to any target on as the outcome?
Maybe I'll just answer it as, I don't want to make it specific to Deloitte. Those constructs exist in the market. Some companies may decide to do it. Some companies may decide not to do it. That's just, there's different ways to how companies get compensated.
Okay, but that model exists, right? The value-based commercial based on the targets.
It exists in the market. I will not indicate whether Deloitte does that or not.
No. It's not specific to Deloitte. Sorry, it's pointing to Deloitte. I was just thinking whether it is there or not. Yeah. Good to know that. Thank you, Abhish.
Well, hopefully this was helpful. I mean, we can take this if there's more interest on another session, because we talked about acquisition. We can pick up divestitures if people are interested in it. That's a little more, painful and not, M&A is a more exciting. Divestitures when companies are selling can get a little more problematic. Maybe next year or later in the year, if there's interest, we can bring this topic up. There's many ways this can be taken.
Sure, we can do that. Yeah. So this was very, very helpful, because like you said in the beginning also, like we hear about the stuff, but not the details of it, right? So this was very helpful to know at least the basics of it.
Yeah, maybe last point there, Manoj, I think you bring that up is when these integrations happen, when it's announced, I would just urge everyone to just reach out to your business leaders, right? To say you want to be involved in this. Because a lot of careers are made when these big deals happen. If you work on deals and if you're the lead on 2 engineering groups getting integrated, or if you're the lead for 2 R&D groups getting integrated, or the lead on 2 product groups getting integrated, it gets a lot of visibility. You're working in a very sensitive environment where you're working with a counterpart who may or may not have a job at the end of it. So what I've seen is a way for your careers to get involved in post-announce. We've seen a lot of our client counterparts do very well. At the end of it, they get promotions, bonuses, all that good stuff. But it's a good career thing to just reach out to your business unit leaders, your corp dev leaders, to say that you would like to put your name in the hat to support the integration activities. It's a double-edged sword, but it's worth it.
Yeah. That's a good point, because one of the fear everybody has that, like, okay, do I have my job tomorrow, right? Especially the
Yeah.
back end operations like finance, procurement, all of those you don't need
Yeah.
double the team,
50%,
right?
40 to 60% is the benchmark on reductions.
Yeah, it is. Okay, I think okay, I think we are Shimna. I think maybe okay. I think this was
Hello,
very
this is Sam John from Oklahoma City, Oklahoma. I have a question about, the M&A for each industry is different.
Yes.
So
Yes.
are you focusing on certain industry or in general?
Yeah. I think just the way my career has moved on, there's a need to specialize, right? So I specialize in energy and chemicals, but I started in a little bit in healthcare, a little bit in tech, but right now I focus almost entirely in energy.
Thank you.
Okay.
okay. Thank you very much, Abhish. This was
Of course.
actually very useful. So we will we what we do is normally after the webinar we'll be uploading to our YouTube. We do have an MEA YouTube channel, so we'll be uploading those also. So whoever could not attend, they can listen to this.
Okay, great.
So
Thank you, Abhish, for that very great session. And thank you all for taking the time to join the first webinar of 2025 board. And this was a great insight topic. And Abhish, you did a great job in that. And thank you, members, for actively taking part in the webinar and making it a good session. And thank you, MEA board, for making it happen. And next, our event is MEA Picnic. It is on April 5th at Jones Creek Park. Kindly, members, please RSVP. Yeah. And RSVP by next weekend through the link provided in the MEA WhatsApp group. So it will be a free event for the members, and please join for fun-filled games, good food, and socializing. Also, members, please renew your membership by logging into our website. Thank you once again. You all have a great weekend.
Thank you.
thank you
Thank
very
you,
much.
Abhish. Thank you, Manoj.